Welcome to the Real Estate Way to Wealth and Freedom podcast with Jacob Ayers, providing actionable content to help you along your journey to financial freedom through real estate investing. As the premier asset class, real estate has helped ordinary people just like you amass fortunes. The benefits of passive income from real estate investing will allow you to live a life you want. And now your host, entrepreneur, real estate investor, and apartment deal syndicator, Jacob Ayers.
Hi, and welcome to the Real Estate Way to Wealth and Freedom podcast, episode 121. I'm your host, Jacob Ayers. Hey, thank you all for tuning in to this week's episode. Well, this week is a special episode in that we have our very first returning guest, Paul Moore. Paul first joined us in episode 2, way back in the early beginning of the show. Today, we're going to be discussing with Paul reevaluating the perfect investment. Now, a lot has changed in Paul's portfolio and investment strategy since we've last spoke with him, so I'm excited to have him back on the show and catch up with him and just see what he's up to today. So without further ado, let's jump into this week's episode. All right, today I welcome back on the show for our very first repeat guest, Mr. Paul Moore. Paul, thanks so much for joining us again.
It is great to be here, Jacob, and I'm so excited to see how your show has taken off since the first time I was on here. You have like way over 100 episodes, don't you?
Yeah, we're pushing north of 115 episodes at the time of this recording, so it's been a really fun journey. Just looking back, you were in episode 2 of the podcast. So it's been a while since we last talked, about a year. And I know you've been up to a lot of new stuff. So I just wanted to revisit and kind of touch base with you and see what you're up to these days and, just reopen that conversation. So really glad to have you on. Looking forward to the conversation today.
Oh man, thank you so much. Yeah, I appreciate it. And so I wrote the book, The Perfect Investment, which was kind of an arrogant title, wasn't it? About multifamily investing, because I was so excited to see the balance between risk and return, safety of principal, yet a really solid growth and cash flow. And when I wrote that book, the multifamily was really, really hot, and we were all thinking, and I've been writing on Bigger Pockets, we've got to be at the top. And hopefully, it's going to loosen up here. But, with the Tax Reform Act that passed 6 months ago at the time of this recording, which was December of 17, I think there's just new life re-injected into the multifamily world. And it's even harder than ever, and I mean ever in history, to get a duplex, a fourplex, a 100plex, anything. Jacob, what are you seeing?
Yeah, Paul, you're not off there. And even in my smaller tertiary markets like Oklahoma and rural Texas, yeah, the markets are still pretty hot, Paul. And you keep thinking that, yeah, this has got to be the top of things. Surely prices are going to start coming down. And, I haven't been in this game an extraordinary amount of time, but it's done nothing but go up. So, yeah, I'm seeing that stuff too, Paul.
Yeah, it's crazy. So I've had to ask myself, I don't really think the title of my book or the premise of the book is wrong. I mean, I still believe everything I said. I believe it is the perfect investment. But I've got to ask myself, has the perfect investment become an imperfect investment? I mean, if you can't find anything to buy except stuff that's overpriced, and therefore it's compressing your returns and your future, got to wonder if it's really perfect anymore, or at least at the moment. What do you think?
Well, yeah, I think that's a good philosophy, and it's a very objective approach you're taking with this. Many people get kind of tribal about what it is they like, whether that's real estate investing or their sports teams or whatever. People get diehard and are afraid to let go when it's wrong. And I really commend you for kind of taking a step back and looking at this and saying, is this still the perfect investment? I think that's a really unique quality and not one that many people could really take. So I'd be interested in hearing your thoughts and, what you're up to these days and, what you're seeing in your portfolio.
Well, so this February, about 4 or 5 months ago, I got a call from a guy, and he was saying, he said, hey, I want to talk about maybe some other things in addition to multifamily. And I said, well, the same thing I said to him that I'd said to everybody for years, which is, well, no interest. Thanks anyway. I didn't say it that way. I was kind of like rolling my eyes to myself, which I've told him later. I've told him since I did that. But he said, look, I'm as committed to multifamily as anybody. And he said, I bought this, I bought that, I'm invested in this, I did this ground up development, and I can't find anything that makes sense. And so I started investing in self-storage. And I said, it's funny. I had mentioned on some podcasts and some Bigger Pockets articles that, self-storage, it seems to me that it has very similar risk profile and return profile as multifamily, and it seems like it did really well in the down economy. And so he and I ended up spending 2.5 hours talking about it over a few calls, and I could not believe the things he told me, and I actually checked it out myself, and it's true. I can tell you, for example, take this one simple fact about self-storage that opened my eyes. If you have $1,000 apartment and you raise the rent as the landlord 6%, you may lose some tenants over that $60 a month. But if you have a $100 a month storage unit and you raise the rent 6%, well, not a lot of tenants are going to say, that's it. I'm not paying that extra $6. And they go out and rent a U-Haul, spend a Saturday, maybe buy a 6-pack for them and their friend. And they go out and they have to spend the day moving all this stuff to another unit down the street to save $6. Now, of course, that thinking has a limit to it. You can't just say, well, we'll raise 6% a month, But there is a certain thought about it, and where renters know typically that they're going to be there for another year and then maybe another year and then another. Self-storage people don't think that way. They often think, well, I'm only going to be there 2 or 3 more months anyway, because I'm going to sell that stuff on eBay. Or as soon as I as soon as I have some time this summer, I'm going to clean it out. Or I'm going to buy another house and, put that stuff in the basement or whatever. But they don't. I mean, obviously some do, but typically they stay many, many, many months more than they plan to. And you take a 6% increase, and then you take another 6% increase later, and all of a sudden, they're paying $112.50 or whatever a month instead of $100, but they're still probably not going to move because they still think I'm only here for a short time anyway. But the compound effect of that is that this industry is much more flexible with rent increases, especially for nice facilities. Now, another thing that happened is during the recession, multifamily did very, very well. We all know that a lot of people were downsized out of their homes or just chose to start renting. And millennials like to rent. Baby boomers are renting more and more. Immigrants are renting more than people who were born in the U.S. So multifamily did very, very well. And that's some of the reasons I love it. But self-storage did really well during the recession as well. And if you think about it, somebody who had a $4,000 mortgage and got bounced out of that or chose to leave that during the Great Recession, they might have gone, pulled back to rent or, rent an apartment, rent a small house, or buy a much smaller house. And what do they need? Self-storage. And they are willing to pay, they had a $4,000 mortgage going down to, let's say, $2,000. Well, now they might be willing to drop that extra $100, $150 a month for self-storage. It's a small part of their total situation. Another thing about self-storage that really surprised me is this. Multifamily, who would have thought, when you or I got into this years ago, that even a duplex has a bidding war now. You can't, as we talked about, it's very hard to find any multifamily at all because it's really popular. Self-storage is popular, but it's a little different. There are 53,000 self-storage facilities in the U.S. They've all sprung up in the last 45 years. And that's as many, by the way, as the total of Starbucks, Subway, and McDonald's franchises in the U.S.
Wow.
Yeah. And get this, 76 to 78% of those are run by independent operators or mom and pops. Only about 22% perhaps are actually run by REITs or really large professional operators. And what that means is there's a whole lot of people who are either, running it poorly or just running it okay. And they're, clipping coupons. They might have bought it or built it in the 80s or 90s, and they're making a 10 or 20% annual return now, and they don't really care. They don't want to go in and spend all the effort to put in systems and people and marketing and all this. They're doing really well already. And so there are like 40,000 facilities around the US like that, or that at least are potentially like that. And this is an opportunity for a fantastic operator to jump in and find deals. I've concluded that it's really easy to run a mediocre self-storage facility, but it's really complex and hard to run a great one. And so I started thinking, after talking to this guy I met on Bigger Pockets and researching this more, I thought, hey, if there are operators out there who are really, really doing it well, they should be able to take a pretty average, even a decent self-storage facility and dramatically raise the income. That's exactly what I found. There are a couple of companies out there, there's probably dozens, but there's a couple that I've talked to and met with in person who are able to go in and with very little or no capital expense dramatically increase revenues and profits just by policy and procedure changes, like adding late fees, adding administrative fees, doing dynamic pricing, adding U-Haul. You can add $2,000 to $3,000 a month to the revenues or more just by allowing U-Haul to run out of your facility. And the cool thing is, it raises having U-Haul at your facility, if done right by a trained person, can actually raise the occupancy another 3 to 5%. So all that put together and a whole lot more, sales of scissors, boxes, locks, tape, a beautiful showroom, a well-lit facility so people feel safe going in there. All these things can really, really add up. And so some of these operators, the one that we're now investing with, they're able to go in and dramatically raise income, and they're able to refinance or sell in like a very short time, 3-4 years. And actually they've averaged 2.5 years, but let's say 3 to 4 years, they're able to refinance, give investors back their principal, and then continue to allow the investors to earn their share of the ownership indefinitely. Or if they sell, they can obviously reinvest. So I just said a mouthful, but that's a few of the reasons. And there's actually more that I really am excited about self-storage.
Yeah, well, Paul, this is a asset class that we're starting to see up and coming. We're starting to see a little bit more exposure to it. Lots of people starting to get involved in it, but it's still kind of on that fringe of being a known, recommended, well-known asset class. So I've got some questions about the asset class in general, and that is, what are the comparisons when financing self-storage property like this? Talk to us about the financing side of it.
Great question. Not a lot of people ask that. Yeah, Freddie Mac and Fannie Mae and other institutional lenders love self-storage, and they're giving similar loans to what you would get for a multifamily. So maybe a 70-75% loan to value ratio. And also there's a lot of bridge loans. This company I'm talking about, actually, we are investing with them now, and they're actually doing a bridge loan, which allows them to go in, dramatically increase the value, which basically allows them to refinance in, let's say, 3 years or sell. And the bridge loan is an easier product to get into. It's actually interesting. U-Haul, the parent company of U-Haul, is actually a REIT, and they actually provide financing for self-storage, and they have great rates and great terms.
Interesting. Well, when you're looking at the numbers on a self-storage, are there any kind of metrics, any rules of thumb that you've found? When analyzing multifamilies, you've got, the 1% rule for single family homes. We all understand cap rates. What are some different metrics you'd see in self-storage?
Well, some interesting metrics are this. Number one, you want to see how many square feet of storage there are in a certain geographic area. And typically they do a 1, a 3, a 5 mile radius, which is similar to multifamily. But what they're looking for, the average in the US is a little over 7 square feet per person of self-storage in, say, a 3 or alternately a 5 mile radius. And it might seem like, wait, wouldn't that be different? No, it's not really. You can look at either one and it should be, let's say, about a 7 square feet per person. So in Naples, Florida, there were almost 0 self-storage facilities in a certain 3 mile radius. And this company we're investing with, they actually went in and they often buy existing self-storage. They actually purchased land and they built a brand new self-storage facility in that area. And they actually, total project cost was about $10 million. They sold that in a couple of years for $20 million. Which gave the investors, since there was leverage, not a double, but more like 4x their money in 2 years. And so one metric is square feet per person. Now, in places like lakes, oceans, recreational areas, it can be even higher. They might need more than 7 square feet per person. Places like Florida, which have both lakes and recreation and ocean, and a lot of people who have some money, they even have a higher number because they don't have basements. So they need more storage. The average person needs more storage. And they don't have attics, or at least they don't use their attics for storage. So that's some metrics. The 7 square feet per person rule is one. Another one is pretty obvious, and that is vehicles per day. You want a self-storage facility that is in a very visible location. There's no set rule because every area is different. But typically, if it's in a normal city, a normal location, you'd hope to have, a place that has maybe 20,000 cars per day or more. Not only do they have to be cars going by, but they have to be able to easily see the facility. And so those are important factors in this. There are other factors like income and other less important demographics. But one cool thing is that people of a lot of different income levels use self-storage. So those are less important factors.
Yeah, okay. Well, Paul, in the multifamily space, we break things down into classes so that we can kind of compare a little bit apples to apples, say Class C apartments to Class C apartments, B to B, A to A, etc. In the self-storage space, does that classification system exist? Are there different types, different qualities, different classes of self-storage units?
Yeah, there are. So one of the things this operator we're investing with does is they'll find one, for example, one recently was built in, one they recently acquired 2 months ago was built in Roswell, Georgia, which is north of Atlanta. And when it was built in 76, it was kind of a sleepy town, more of a farming area. And it was built, and it was fine. But I mean, it's, what is that, 42 years old now. And so it was a little bit aged, and they had added on to it, but it didn't have a fantastic showroom, didn't have a great, colors and all the point of sale and all the signage and all that. So they're going in, they're putting in a beautiful first-class showroom, all the colors, everything is laid out. So when the person walks in, it draws your eye to these different things that, people need, like, the boxes and tape and all that. But they upgraded the lighting, upgraded the colors, upgraded the name. And so they're upgrading this from, let's say, a B facility, and especially because of location. The location is just boomed around there, as you can imagine, north of Atlanta. And so now it's an A or maybe even an A+ facility, though it's older. It's pretty rare, Jacob, in my opinion, to have a really older, although it does happen, an older apartment complex that you can get to an A or A+. But they're able to do that. But there are classes, I think that they break them down into A, B, and C in general.
Yeah, okay. Well, one thing that comes to mind, Paul, when I'm thinking of self-storage units are, hey, it sounds like a lot less maintenance and a lot less management. Are those accurate statements?
It is a lot less maintenance. I think it's about, well, I shouldn't quote a number, but it's a much, much lower number in maintenance. However, and that is, by the way, one of the ways this company upgrades. They actually put in rubber corner or plastic corner guards and things like that to help with maintenance. But the management is surprisingly high for this company. And that really bothered me at first. I assumed before I knew anything that they had, completely automated. It's all automated. Everybody gets a code. There's cameras everywhere. There's actually no employees. That's not the case at all. They actually have 2 full-time employees for let's say a 100,000 square foot facility. And that would be, let's say, 1,000 units, for example. They would have 2 full-time employees. One lives on site, and that's part of their comp package. And then they both go out and they attend Chamber of Commerce events. They meet with realtors. They do other types of events in town. They do marketing, not only billboards. Only about 12% of people find self-storage facilities online, if I'm not mistaken. And so they're really trying to increase their online presence. That may not sound right, but I think as more and more millennials enter into the fray here, more and more people are going to be finding these online, and they want to be ahead of those independent operators I mentioned, the mom and pops who might not have a great website. But no, it's not as light on employees as you would think, but the revenue that a great self-storage company can build in is more than compensates for the extra employee they might bring on when they take over a facility.
Yeah, okay. Well, Paul, switching gears here a little bit, I want to go back and talk about your mindset when you started to shift focus from multifamilies to self-storage. And, sometimes people probably don't have that sense of ability to swallow their ego, if you will, and start looking at something else. So you managed to do that. Kind of walk us through the mindset of, you've written this book called The Perfect Investment, made a bold statement, threw all your weight behind multifamily. And not that you're totally abandoning it. You're just saying, hey, it's not working right now. In the meantime, I'm going to have to check out other vehicles. So can you walk us through the mindset of that shift you had to kind of overcome?
Yeah, absolutely. So, and I'm thinking about a new book called The Perfecter Investment. What do you think?
Hey, in Oklahoma, in Texas, that might fly just a little.
Hey, I'm in Virginia. Come on. But
okay.
No, in all seriousness, folks, I still love multifamily. We've looked at 180 multifamily deals in the last 5 months, and we still love and want to pursue multifamily. We're just not finding it right now. I'm also studying. I'm studying Warren Buffett right now. I've written 4 Bigger Pockets articles about Warren Buffett's advice for real estate investors, if he was talking to us. And I've taken a lot of his wisdom and a lot of the different things that he does and he teaches, and I've actually tried to apply it to what if he, what would he say to you and I as a real estate investor? And what I realized about Warren Buffett is something we all know, but he doesn't really start companies. He doesn't go out and build companies from the ground up. He's more likely to find a great company with a great product in a great market and then throw capital and maybe some systems behind that company to help them really grow. And that's what I decided I wanted to do. I thought, I'm in my mid-50s, my partners are as well, and we don't see, I don't personally want to learn to manage a self-storage facility. I don't want to learn all the ins and outs. I don't want to go to the boot camps, if there are any. I don't want to do all the training and learn to be a property manager. And so I thought this was a perfect fit because I thought, wait a minute, we're still committed to multifamily. What if we just pooled our investors together and wrote one check for several $1 million and just handed it to a great syndicator, a great sponsor who's already doing a great job in multifamily, just like Warren Buffett, will throw a large amount of money behind some company to help them grow. And that's exactly what we're doing. And so that's my mindset right now. My mindset is that I want to learn enough to analyze the deal. I want to go to the location, and I did go to Bradenton, Florida about a month ago to view this location before any of us invested. I want to meet with the CEO and the operators and look in their eyes and, really trust them and all that. But I don't want to have to learn to operate it myself. And so that's my mindset as we've switched. Another part of my answer would be this. We had investors who invested with us in December, 6 months ago, in a multifamily facility in Lexington, Kentucky, who were already getting impatient by February saying, hey, when's the next deal? It's been 2 months. I got more money. And we didn't know what to tell them. And we knew some of them were leaving us. So we could have done a couple deals in multifamily and maybe overpaid for them, or we could have just told them, sorry, hold on. And that's when I started to expand my thinking. I thought, I know, once I learned about multifamily, I realized, I know these opportunities exist that are really good. And I've got these investors that trust me, and I want to invest in this myself. Why don't we just all pull together and do this? And so this has been a great fit for us, and the returns are surprising. I'll tell you that.
Yeah, it's really interesting stuff, Paul. And it brings up a good point. And that is, when you set out along this journey of real estate investing, that is, you kind of have to start with the end in mind. And the end for a lot of people is cash flow or financial freedom or wealth creation. And then they back calculate and figure out what that vehicle is going to be. Most people realize that their 9 to 5 engineering job isn't going to get them there. So they start looking at different vehicles, and lots of people land on residential real estate. And then they get so ingrained in that vehicle that they don't ever want to get off of it and go into a different vehicle when it's not taking them to that final goal. So you found a way to kind of pivot, check out a different vehicle that still gets you to your goal. So really cool there. And I just really commend you for being able to make that pivot, make that mindset, because it sounds easy enough just to completely do a 180 and start investing in something else. But really, it takes a mindset shift too.
Mm-hmm. Yeah, I really appreciate that. And my investors have been very kind. I wrote them a letter in May called something like Confessions of a Multifamily Sponsor. And I said, I've got to be honest with you, I have not served you well. And that's how it started. And so thankfully people read it. And I said, I have not given you the investments that, that your cash sitting on the side. I got a lady with $500,000 in cash waiting to invest. And she missed our last deal because she didn't act super quickly. And she's investing in this one. But, I said, I have not served you well. It's not like necessarily my fault or anything, but I mean, limiting us to multifamily has just limited us, right? And so I didn't know how the investors would respond. And I mean, I cared, but I didn't, care a whole lot, because I mean, if nobody wanted to do self-storage, then that was okay. I mean, I want to do it, but that doesn't mean anybody else necessarily does. But the response has been overwhelming. And I just talked to an investor an hour ago from Kentucky, and he didn't know anything about self-storage. And within 10 minutes, he was actually saying, wow, I need to open my mind up to this. And he's been thinking about only multifamily for a long, long time.
Yeah, definitely so. And I could see how that's the case. Now, one thing, I'm looking at this asset class, Paul, and I'm thinking, well, there's probably not such a thing as a 2 or 4 or even 10 unit self-storage property out there. So that kind of limits the barrier to entry. There's probably only high volume properties out there, 100 plus units. So it really prevents people from getting started with small amounts of money. Would you say that's a fair statement?
I hadn't really thought of that, believe it or not, because the company we're investing with is, going for 50,000 square feet and up. By the way, the average square footage of all the facilities in the U.S. is about 50,000 square feet. Yeah, I think that's true. The smallest deal I've seen, which was not one I would invest in, was about 100 units. And it's about, let's see, I think it's 10,000 square feet. I think it's actually more. I think their average square footage is more than a 10 by 10. And there's all kinds of different sizes. But no, I think that's a very good point. So that would be that would have been about a $1.2 million facility. And so unlike, I bought a duplex for 90,000 once. I don't think you're going to find any self-storage for 90,000. That's a great point.
Yeah. Well, hey, walk us through that quick napkin math you just did on a 10,000 square foot facility being worth a ballpark 1.2 million. How'd you come up with those numbers?
Well, actually, that was the selling price that somebody was selling here near my home, and I just looked at it, looked over a friend of mine's shoulder who was looking at it. But the math would be, let's just do it live, and if I screw up, so be it.
Yeah, no big deal.
Let's say that the total income on it. Oh boy, I really should have some real numbers in front of me. But let's say the total income on it is about $100,000 a year. That's the net operating income after all expenses, but before the payment of the loan. By the way, the average net operating income in self-storage is 44% nationwide. So I guess it would be about a $225,000 gross income, and it would net out to about $100,000 in net operating income. And if you apply about an 8% cap rate to that, that means you divide the $100,000 in income, divide by 8% or 0.08, and that would give you $125,000. If I did the math right in my head, that would give you, a $1.25 million sales price. And so I think that's about what it was. I think what I just did was about what it turned out to be. And so the question I would have for my friend would be, would that take a different operating strategy? I mean, if you have 100 units, you wouldn't certainly have 2 full-time employees, but would you have any? I don't know. I don't know how to operate that. I don't know how to operate a 10-unit apartment either, for the same reason. I kind of know how to do a duplex or a 4-plex, but how do you do a 40-plex? I mean, is that a word? I'm not really sure, because it's not large enough to have an on-site management team, which is all I really know about. And it's not small enough that you'd have a third-party company in town, although maybe that's how they do it. Do you know?
No, I don't, in terms of the self-storage unit. No,
I'm talking about for apartments now. I'm saying if you had a 40 or 50 or 60 unit apartment that's right between the small and the large, I'm not sure how to operate it. And I'm not sure how to operate a small self-storage either.
Yeah, there are a lot of operators out there that won't kind of touch those middle-sized apartments because you're almost right there in that no man's land. Doesn't quite justify having on-site property management, but is a little larger than you would need just having a third-party manager operating it from remote. So yeah, you're right. A lot of people kind of don't like that middle ground. They either go small or go super big. So yeah, well, that's interesting stuff, Paul. I just wanted to pick your brain on a couple of those things around the self-storage. It's a really interesting asset class. And, like we mentioned earlier in the show, I think it's on the up and up in terms of gaining a little popularity and a little more exposure to the marketplace. So it sounds like you found a good operator you're working with. And will you tell us a little bit about that relationship?
Yeah. So this operator actually has... they were both the owners were actually part of a much larger company years ago. And when they went out into business on their own, I think that was about 10 or 15 years ago, they actually teamed up with a large family office. And that family office, which is, like a multi-billionaire, actually it's the owner of a sports team that we would have all heard of. They cut a deal with these guys and said, hey, we're going to take 90 or 95% ownership and you'll get 5 or 10% ownership. And so these guys were doing, and they had a very, very large checkbook. And so they sacrificed a percentage of ownership for the convenience of having a large capital source that really liked them, would open up their checkbook and regularly write checks. And they were getting a small ownership percentage, but they were also the property manager. This company that I'm talking about actually they charge 6 or 6.5% to manage the property. So they were getting all the property management fees, which were paying their bills. and they were giving them a 5 or 10% ownership as well. Well, typically, as you know, Jacob, in a syndication deal, there's an 80-20 split, 70-30 split, 60-40, or even 50-50, which means in the 70-30 case, the most the most likely case, there will be 70% going to the cash investors and 30% back to the syndicator, the sponsor. Well, like I said, they were getting like 90-10, which was, obviously they were getting a third or even less of a typical deal.
Sure.
But 70-30 is more normal. So they decided a couple of years ago to branch out, and they said, well, we're just going to go get our own investors. So they started working with dozens and dozens and probably hundreds of individual investors putting in 50, 100, 200,000 each. And they have been giving them phenomenal returns, but they decided fairly recently, the CEO, he said, I'm spending half my day every day not doing acquisitions, not doing operations, which is what I love. I'm spending like half my days on the phone with investors. And I don't want to do that. So they have gone to their third model now. And their latest model is to find a handful of companies like Wellings Capital, which is my company, a handful of companies like us who will pool investors together and write one large check. So their goal now is to find, let's say for an $8 million raise, to get 4 groups like Wellings Capital to put in, let's say $2.5 million each, and they're there. So that's my relationship with them. They're reporting to us as one investor, and then we are reporting to our, say, 30, 40, 50 investors individually for their, for their own investment.
Yeah. Okay. Well, Paul, as I remember last time, you have a really big reason why, and that's what's driving you to do all this stuff. Will you talk to us about why you're doing this and what's driving you to build this lifestyle that you have?
Absolutely. Well, every year I get older, and a lot of people say this, I just really realize, I want to leave a legacy. I mean, while I'm breathing air, I might as well change the world. And unfortunately, there's some really, really awful people out there who are changing the world in horrible ways right now. Backing up, if I was an adult in the 1960s, I want to believe that I would be standing up for civil rights. If I was alive 100 years earlier in the 1860s, I want to believe that I would have been an abolitionist and fighting against slavery. Well, Jacob, there is a horror going on right under our nose right now, and it's called human trafficking. There are 30 plus million people who are sex slaves and trafficked, and they've been snatched from their homes. I mean, this is similar to the population of, like, your state, Oklahoma, my state, Pennsylvania, Ohio, West Virginia combined. I didn't do that math, but it's something like that. Imagine every one of those people being immediately whisked away and being gone. And that's what's happened. And get this, if you took the total record year profits for Apple, Nike, General Motors, and Starbucks, added that together, doubled that number, that's less than the estimated annual revenues that are derived from human trafficking. This is a modern day horror, and it's not as obvious as slavery was or the civil rights movement, but it's in the same exact league as far as horror. I don't even want to get into what has happened to these people, but I'll tell you this. These traffickers make up to $250,000 and even up to $500,000 per year per girl. Now imagine the horror of that. We all know what happens after 1 or 2 horrible events. We're talking about dozens a day. And so I just can't sit by and watch this. So I have teamed up with some other folks. One group's called Exodus Cry. Exodus Cry has put together some films documenting the horrors of this. One of their famous films is called Nefarious, and they're actually based out your way near Kansas City, and they are actually documenting. They have 800 hours of film footage they shot around the world. Their founder testified before the UN recently, And they're exposing the horrors of human trafficking. There's another group out in Kansas City I love as well. I talked to the founder yesterday, and we're so excited to help them, to help fund them. But I want to raise, I said $1 billion before. I want to raise billions of dollars to fight this evil and do other things. And one of the ways I'm doing that is I'm teamed up with a guy named Ben Briggs. Ben Briggs is south of you a little bit. He's in Dallas. And he has a wonderful real estate company called Sotheby's. It's Briggs Sotheby's Realty. Ben himself is the grandson of the founder, and he's on the ground in China. And he is actually working with very large investors, people who want to write minimum checks of $50, $100 million, $200 million. And he's investing in real estate projects. But he and I are working together with a team of people. This is Ben's baby. I'm just joining him. To build a $1 billion office complex in Dallas. We want to use that as a prototype. We're going to obviously pay for the land and the building and the construction and everything else. But we want to take all the syndication profits, the 20% in the 80-20 split, if you will, and we want to use that to fight human trafficking and rescue its victims. And we're estimating the profits from the first project to be about 100 million or more. And so we're in the planning stages of that, and we want to do it again and again. And so that's my big why. Sorry, long answer.
No, Paul, I love it. And I think that's so important. You know, it's terrible that stuff happens, and the world needs people like you to fight against that. And, you know, they need a lot of people to join your cause and help you. But going back to having that reason why, you know, I just can't emphasize how important it is to have, you know, something that's bigger than yourself that you're aiming for and working towards, because, you know, we've talked a lot about, you know, how this business can be pretty difficult at times. And if you don't have something driving you and motivating you, then, you know, you're that much more likely to give up or, you know, take it a little easier and not push as hard. So really great stuff you're doing there. It's really exciting to see, you know, your transition from multifamily to the self-storage asset class, you know, keeping up with you and just all you've got going on these days. So I really enjoyed, you know, just touching base and, you know, kind of revisiting where you've been. So it's been really exciting.
Thank you so much. I really appreciate the opportunity. By the way, the website for what Ben Briggs is doing is freedomplaceproject.com.
freedomplaceproject.com. We'll link that website in the show notes. Paul, it's been a pleasure speaking with you. Now, for our audience members that want to learn more about you, reach out to you, connect with you, where's the best place for them to do that?
They can find me on Bigger Pockets blogging. They can also find me on How to Lose Money. How to Lose Money is a wealth building podcast where we talk to successful investors, entrepreneurs, business owners about how they've lost time, money, relationships in the past, and how they're now learning from that and not replicating that in the future. And I think you're going to be a guest on How to Lose Money pretty soon, aren't you, Jacob?
That's right. Yeah. So in an upcoming episode of How to Lose Money, you'll hear my voice on there with Paul interviewing me. So be on the lookout for that. It's going to be really fun.
Yeah, I can't wait. By the way, we also have a website, wellingscapital.com, and you can reach out to us at wellingscapital.com.
Awesome, Paul. Well, thanks for all that information. It's great to touch base with you. I'm excited to have you back on the show a third time. So till next time, take care.
Thanks, Jacob.
All right, that wraps up our episode today with Mr. Paul Moore. Now, Paul has given us a lot of actionable content here, but more importantly, I think what Paul has given us today is some mindset content. And that is, Paul is constantly reevaluating and retooling his investment philosophy, always keeping his eye on the end goal and just treating these certain asset classes as vehicles to get him there. So I think that's the important takeaway in today's show, and one that you can implement in your life immediately. So hey, if you like what you've heard or have any comments or questions, please reach out to me and leave a rating and review in iTunes or Spreaker or iHeartRadio or wherever you're listening to this podcast at. For more information and resources or to connect with me, visit www.jacobayers.com. Till next time, signing off, I'm your host, Jacob Ayers.
You've been listening to the Real Estate Way to Wealth and Freedom podcast, providing you actionable content to build your real estate empire. Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for personal advice. The opinions of guests are their own. Information is not guaranteed. All investment strategies have a potential for profit or loss. The host is operating on behalf of the Real Estate Way to Wealth and Freedom, LLC exclusively.